Let me now bring on board Sanjeev Prasad, Senior Executive Director and Co-Head Institutional Equities with Kotak Securities. Sanjeev, good morning. Always a delight to have you back. Sanjeev, the moot point is that the budget session will start today. So to your mind, apart from a reformist budget, what exactly are markets expecting from this budget session?
Well, I guess it will be two things. One is the fisc per se, and whether the commitment which the finance minister already made to curtail fiscal deficit to 4.8% GDP, whether that will be kept or not. I assume that will be the case. And other thing which people will want to look at it is, what other reform measures the government / the finance minister can announce in the budget, which will result in growth coming back into play, because that's been a big concern. Growth is slowing down in the country. So whether it is through a combination of measures which can result in investment cycle picking up, savings rate picking up, investment picking up, all those measures as and when they get announced, those will be taken positively by the market. So it will be a combination of what you see on the fiscal side and what you see on the growth side. So somewhere the government will have to play a balancing role between, on the one side, fiscal consolidation, which is to some extent negative for growth, and the second other side is what the government can do to revive growth at the same time.
How do you think he will balance it? Because if he maintains the fiscal side, he will have to go easy on the expenditure side, and if he goes easy on the expenditure side, that will challenge FY14's growth.
No, clearly, see, this is going to be a long haul. It's not something which you can address in the short term. But the government has already started on the process of fiscal consolidation. I don't think we have many options over there but to carry on with it, given the fact that the finance minister already committed to it. Plus, we also have issues in terms of the external rating of the country, plus whatever signals you're giving to overseas investors. Do keep in mind the fact that a lot of India's expenditure is somewhat, wasteful, I would think, particularly the ones related to subsidies. As of last count, subsidies account for almost 2.5% of India's GDP, and that is, I would say, pretty much non-productive use as far as the government's finances are concerned. So I think fiscal consolidation is something which India has to do, and unfortunately it will also result in some amount of impact as far as growth is concerned. So the important thing is now what the government can do to revive growth. On the other hand, while consumption is slowing down to some extent, can we take sufficient measures to influence or increase the investment rate? Now this is unfortunately a long-drawn process. It's not something which you can turn around immediately. And as long as you see the right measures being announced and the right steps being taken, I think it is still going to be a positive. Investment cycles take time to turn around. Whatever steps you take now will probably reflect in 18-24 months time. Also, you need to put in place a number of building blocks. The land acquisition has to be made a lot easier. Resource allocation probably more transparent. Environment approvals and other project-related approvals have to come in much faster. So all those things would need to be addressed. Some of this would have to fall in the legislative domain, some of them would be in the executive domain, but clearly we need to see a situation where the government is working a lot faster on correcting some of these issues which have stalled investment for some time. So India has to get back to a model of more balanced growth with consumption maybe on the lower side, but investment picking up. And the second one is also very, very important from the perspective of current account deficit, as also job creation, both of which are serious challenges in the economy.
Sanjeev, let's stay with the mid-cap space. What, to your mind, has led to such a strong price correction in the mid-cap space? Lack of earnings visibility, extended valuations, or leverage market problems?
I think it's a combination of all the three. One thing which has happened is earnings numbers, we are not seeing any great upgrades over there. In fact, if you look at the third quarter numbers, in general, the numbers were disappointing for the mid-cap space. Overall, the numbers still came out to be okay, but if you exclude the large cap names, in general, numbers were somewhat disappointing. And barring a few sectors such as, I would say, oil and gas and banking to some extent and IT, in general there has been a lot of disappointments across the board. So obviously, people are getting nervous based on the fact that your consumption cycle is slowing down. If you look at underlying trends in volumes, margins, profitability across sectors, very disappointing numbers this quarter. So the concern is that if the economy is slowing down, clearly it has a far bigger implication on the smaller names, which have obviously far smaller balance sheets and the resilience to tolerate a extended economic slowdown. And I think the concern is starting to build in that you could probably see maybe 18-24 months of extremely slow economic growth. And if you look at 2013 GDP growth, we are looking at 5.1% as of now. 2014 our forecast is 5.7. But looking at the underlying trends and volumes, you look at across the board, you look at consumer staple numbers which came out in this quarter. In general, the trend is down. You look at Hindustan Lever's numbers, for example. Last 3 quarters, the volume growth on a YOY basis have been 9, 7 and 5. So clearly there is a slowdown over there. You look at auto sales numbers, for example, car volumes last 3 months have been negative on a YOY basis. Last 2 months it's been negative 9% actually YOY, both for December and January. So if that is the case for autos, clearly the auto firms will get affected a lot more. And given the fact that the balance sheets are not as great as the OEMs, clearly it will be a problem for the smaller companies.
Sanjeev, so you're only telling me the bad news. What is the good news now?
Well, unfortunately, you don't have a lot of good news. You have problems in the economy. Let's be clear about it. Thankfully, at least at this point in time, the government is aware of the problems and is taking steps to rectify the problems. Let's look at various issues. Fiscal numbers. In the middle of last year, we were looking at as high as 6% gross fiscal deficit to GDP for fiscal 2013. Hopefully, we will end up at 5.3, 5.4. And next year, if the government, continues with its reform process on the oil side, hopefully we could be in the range of 4.7, 4.8. It depends on the oil subsidy math, where global crude prices are, how much fuel price increases take place. But at least now we have some amount of confidence that the government is doing the right things in terms of fiscal reforms. It will take some time to rectify the government balance sheet, obviously, but at least the process is on in terms of the gradual deregulation of prices of various products like fuels, etc. Hopefully the direct benefit transfer scheme, direct cash transfer, whatever, call it whatever, that will also get rolled out over a period of time. In the next 2-3 years you will see some of the leakage in the system also getting plugged as far as food and fuel subsidies are concerned. So hopefully that will also bring down the subsidies over a period of time. So clearly fiscal reforms, I think, moving in the right direction. Look at the second area, which is current account, and that is still a lot of concern over there. It's not something which you can address in the short term. Unless and until your exports pick up in a meaningful way, it's not going to improve. Unfortunately, for exports to improve, we have to do a lot of work in the back end in terms of improving the overall investment climate in the country, making domestic manufacturing a lot more competitive, and overcoming the infrastructure deficit in the country. So this thing will take time. What we can hope for is 2 things. Crude prices come down, so that gives us some breathing space on the current account side, and hopefully capital flows continue, which results in some of the deficit which we have in the current account side getting offset because of strong capital flows. That's only hope over there. Unfortunately, you don't really have much of a solution. Third area to focus on, which is a matter of concern, is the investment cycle, where unfortunately you're not seeing an investment at this point in time. Again, the government is aware of the situation. Steps are being taken to address this, but it's a long drawn process. Land acquisition bill will hopefully get passed, which will hopefully make land acquisition process a lot more easier. CCI has started meeting more frequently, trying to clear up projects or expedite the whole process of government related approvals. So we are moving in the right direction, but the problem is the problems are of a fairly large magnitude, and this is not something which can address overnight. It will take a lot of hard effort by the entire economy, both the government and the private sector, to rectify the situation.
Right. Sanjeev, I just want to talk about the oil and gas space. Currently, you have a buy rating on ONGC and a reduce on Reliance Industries. Will the recent news of further capex by RIL, in tow with BP, not encourage you, and therefore wouldn't you raise your target on this one?
No, this is something which has been known for a long time. It's not something which is new. I mean, last 1 year, we have been anticipating some increase in gas production from fiscal 2016. But looking at the press release which came out yesterday, the new resources doesn't look like it's going to come into play before fiscal 2018. I mean, the press release says 2017. I assume it's calendar 2017, which effectively pushes us into fiscal 2018. So, unfortunately, it looks like there's somehow a delay compared to whatever expectations we have in terms of recovery and gas production from the satellite fields of the KGD6 block. Other issues are pretty well known in Reliance. Refining margins are doing reasonably okay. Chemical margins, you're seeing some signs of improvement, although still at a low level. Gas production in the short term is declining. We have already assumed $8 per million BTU gas price from 1st of April 2014. So all this is already there in the stock price. So the stock requires a lot more positive news, something which is not known by the market. Just reiteration of the same news shouldn't result in market cap, going up. On the other side, if you look at ONGC, the stock is trading at about 10 times 2014 EPS. We are not assuming any upside to the company's earnings from deregulation of oil prices or deregulation of gas prices. So as of now, we are just assuming a asset situation as far as ONGC is concerned. I mean, even if you look at this year, the company will do somewhere about 30 rupees EPS. Next year, hopefully with Sedan, etc. coming back, it will go to about 33. The concern in case of ONGC would be the subsidy sharing arrangement between the government and the upstream companies. If the government changes that to the detriment of the upstream companies, that becomes an issue. But as long as the government plays fair on oil price deregulation and a gas price increase, ONGC's earnings should look up pretty smartly.
Right. Okay, Sanjeev, good chatting with you. Appreciate you taking the time out and joining us on the show today.